All right, so thanks for joining us, everybody. So it's Sunday, August 13th. We have a relatively small group today, and Hadi is not joining us, unfortunately. He has to do some international travel. But let's see what we can do, what we accomplish, in this group. Okay. So my plan for today, we'll probably have a relatively short session. We'll do a quick update on the US macroeconomic indicators. We'll talk a little more about China's economy. That tends to be a topic of interest for the students, including both deflation and defaults from Evergrande and to Country Garden. And we'll have an open discussion. So any questions you want to ask are obviously very, very welcome. All right, so macroeconomic indicators. Macroeconomic indicators are continuing to look exceptionally well. So unemployment rate went down a tiny bit in July, so it's at 3.5%. So it's very low, very stable over the past 12 months. If you look at the labor force participation rate, which had been relatively low for the United States, it's fairly stable. And so I'm not seeing really very much change since March of 2023, right? So inflation, if you look at the inflation from the perspective of consumer price index, it went down quite a bit to 3.3%. I think folks expected to see around 3%. So 3 is a little bit higher than what is expected, but still pretty good, right? And if you look at core inflation as measured by core CPI, it's also down at 4.7%, even though it has not gone down quite as much as the overall consumer price index. And in the past session, we talked about things that kind of influence consumer price index more, right? We've stripped away the volatile categories from here. The prices of housing, prices of rentals continue to be very, very stable. So all of those things are very good news. They indicate that what the Federal Reserve is doing in terms of monetary policy seems to be working fairly well. And even better than that, it looks like the likelihood of a soft landing in the economy, so not pushing the economy into recession by contractionary monetary policy, so that actually is going to take place. And I think most analysts kind of are starting to predict that. Hadi and I both were in the group that said, well, I think things are good. Sort of you're not expecting an inflation based on what we're seeing. And sort of it looks like it's rolling down that way, which is great. So, sort of this is just, a quick graph that shows what's happening to the core CPI and the overall CPI, right? And overall CPI, you can kind of see there is more volatility in there. Core CPI is more stable, but the fact that the core CPI had increased quite a bit, it's going to take a little bit of time, probably still another year, maybe a couple of years, I would think, to take down that core CPI. So there is still, some work to do in here. And by the way, feel free to just, sort of if you want to ask something, just unmute yourself. Nadim, what's your question? Go ahead.
So, Professor, what's the difference in brief between core and overall CPI?
So essentially, core CPI, this is the preferred measure that the Federal Reserve uses. And this measure strips away the prices of energy and prices of food from the price index, right? And the idea behind that is that there is generally a lot more volatility in the prices of energy and prices of food, because, a lot of it actually comes from the energy prices. A lot of it is embedded in the food prices. But if you strip those, you get a much more reliable indicator of inflation that is not going to fluctuate all that much, right? And sort of this kind of like this certainly seems to confirm that wisdom. This is not to say that the overall inflation doesn't matter. It absolutely does. But that core CPI seems to be a more reliable prediction of inflation kind of in the medium term. Did I answer your question? Does this make sense?
Yep. Thank you so much.
Okay. All right. Very good. And so things are going well in the United States, but let's pivot over to China. China is not doing quite as well. So China is starting to experience deflation. And if you look at the numbers, prices fell by about 0.3% year over year. So the period of August 1st, 2022 to July 31st, 2023, prices decreased by 0.3%. This is fairly considerable, especially if you take into account, I mean, look at, sort of what we've seen. Okay, I'm trying to draw with a red marker, but it's not working for me. Okay, hopefully. But, sort of look at previous experiences, right? Sort of China typically had higher inflation. It's a growing emerging economy, which had been growing quite fast. And so to have inflation dip into this territory, that's pretty unusual, right? Sort of there was a short period of that during COVID, right? When aggregate demand had been pushed down considerably because of closures, and so that's understandable. But right now, this is not looking good for China at all. And so the idea in here is that where is this deflation coming from? Well, there is the pressure from prices of exports, and I'll show a few graphs shortly. There is a considerable housing slump in terms of the prices of real estate. And what it looks like is kind of a bit of an economic stagnation, not stagflation, mind you, right? But it's an actual stagnation. And so exports, for example, fell by about 14% year over year in US dollar terms.
May I
Go
ask
ahead.
a question?
Of course.
The US is doing okay, and then so we are still spending money and all that, and a lot of exports that US, I mean, imports for US are coming from China. So does that mean that China's export to the US has been decreasing over the years?
They absolutely have. So if you look at, let me actually just run through this slide, and then I'll show one more slide that kind of shows. Actually, let me do this. Let me see if I can jump ahead to this. But this is what China's exports look like, and sort of this is the growth rate, right? So generally speaking, as long as you are here in the positive territory above zero, that's good, right? But the overall trend had not been great. So if you look at exports, the growth in exports have been going down, 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 right? And so right now, I think this is actually as of June of this year, the exports overall went down by 12.4%. And I think July data shows about a 14% decline. So this is very considerable. At the very same time, the imports have been going down as well, right? Sort of, you can kind of see that they roughly go together, but they haven't slumped, sort of in the last year by quite as much. And the fact that those imports have gone down, sort of that also shows weakness in aggregate demand, right? Sort of Chinese consumers are not buying goods and services that were made abroad. So that's a fairly big challenge. And I'll just show the slide that actually answers your question. So if you look at, sort of this one is how much out of 100% the exports to any given country account for, and the United States accounts for, 14% roughly of total exports during the first 6 months of this year, which is this is 1/6, right? Sort of this is big. It's not necessarily huge, right? But it's very, very significant. And if you looked at what happened to the exports to the United States, they fell down by about 12%. So one country that actually experienced a significant increase in exports is Russia, right? But Russia doesn't really have a lot of other choices. So Russia, sort of is, under sanctions from the majority of Western countries. So the exports, Russia's imports from China increased by nearly 100%, but even that meant that it accounts for 3% rather than 1.5% as of a year ago, right? And sort of Russia is not going to, solve this issue that China is experiencing in terms of exports. And so some of the explanations is that, sort of why the exports have gone down is that, generally speaking, sort of if you look at the overseas factories, there is a bit of a slowdown. And so they're buying fewer goods from Chinese factories, so that's part of it. But for the United States, it's also the change in the United States export-import policies that is starting to, starting to account for some of them, right? And so, Biden's administration had taken a number of steps to kind of in-source exports. I don't think any of that is really showing so far in those numbers, but that will likely start showing up pretty fast, okay? So, let me just jump back to the previous slide. And so just talk a little bit why deflation is dangerous, because we don't like seeing too much inflation, right? Sort of too much inflation is bad. Deflation is also pretty bad as well. You're generally looking for that Goldilocks territory of inflation being positive, but under 2% or so for industrialized economies, and maybe under 4% for the emerging economies. So we often talk about inflation being as this little bit of oil on the gears of the economy, right? And when you see a country experiencing deflation, by definition, this is decreasing price levels in the economy, right? And so in this case, why deflation is why deflation is happening in China, it's really the decrease in aggregate demand for goods and services. And if you think about the impact of deflation, which is negative inflation, right? It's the idea that if the prices are going down, then consumers will stop borrowing or will reduce their borrowing, because repaying this money in the future becomes more expensive, right? The real interest rate that you're paying on your debt is very high. And consumers will also change their spending habits, because if you're seeing the prices going down by 1%, couple of percent every year, in some cases more for some categories of goods, if you can wait, you are going to wait to buy something, right? And this creates a huge disincentive to spend and a considerable incentive to save, which means that, borrowers of course are going to be hurt. But more than that, I mean, you have this vicious downward spiral where as prices drop, consumers spend less. That creates more unemployment because factories and producers of services essentially will fire people. That means as unemployment rate increases, people start saving even more and consuming even less. And that spiral will start turning and turning and turning. And that's what we want to avoid as much as possible, right? That could be fairly bad, and it was fairly bad in the United States. If you look at the Great Depression, sort of that was a very big part of this, sort of this cycle. But anyway, we've kind of looked at those charts already, so which is great. And
well, Professor, quickly,
go ahead.
Mm-hmm. Sorry to interrupt. Why deflation is bad for consumers?
Well, think about it. The reason why deflation is bad for consumers is that you're you're basically being forced, sort of your initial decision to spend less now and to try to shift your consumption into the future. It basically contributes to a decrease in aggregate demand now, right? And that increase in aggregate demand will lead to unemployment. And once you see unemployment increasing and the nation's economy not doing well, then you're going to adjust your own decisions even more, right? Because even if you keep your job, you kind of look at somebody who's worked with you and who has been laid off, and you're saying, well, the likelihood of my being laid off is becoming higher now, right? And so that's what creates this cycle where people are trying to save more, spend less, and the economy goes into a spiral where you have continuing negative economic growth or basically shrinkage in the GDP. Okay, does this make sense?
Yep, thank you.
Mm-hmm. And of course, remember, if you have a mortgage, that's bad for you, right? Because basically you're paying the, sort of the real cost of your mortgage has increased. Even if you were lucky and you got a mortgage at 2.5% interest, but you have you have deflation of roughly 2% a year, that means the true cost of your mortgage is now 2 percentage points higher. Now it becomes 4.5%, right? Sort of that's significant consideration for something like that. Okay, so talking about China and talking about the role of exports. So the slowdown is really not entirely explained by the export slowdown. That's only a fraction of it, right? And if you look at the real estate problems that China is experiencing, they are considerable. So first of all, China's real estate, and there is a variety of measurements in here, and so this is why you're seeing so much, inconsistency in this number, right? I mean, 23 to 30% is a considerable delta, but depending on how you count, real estate and related industries, to say that it's roughly 1/3 of China's economy is probably pretty fair. And if you compare it to the United States, in the United States, it's about 17 to 18%. I mean, it's probably under 20% no matter how you count it, right? So this is considerable. This is almost twice as much as the United States if you take the upper boundary into the account, right? And what's even more troubling is that if you look at households' wealth, their real estate holdings account for about 70% of the household wealth in China. And in the United States, it's very significant at 50%, right? Sort of your average household, your median household has about 50% of their wealth in their housing, which is high, right? Sort of it's typically the number one source of wealth for the households, but 70% is extremely high. Back in 2021, we've had a default of Evergrande, one of the largest Chinese property developers. And so Evergrande, I think, defaulted on the debt of about 300 billion to 330 billion or so, or rather, this was the overall debt. It didn't necessarily default on every single item in there, right? But generally speaking, if you look at this debt, that's about 2% of China's GDP. Or if you want to compare it to the United States, this would have accounted for 1.2% of United States GDP. So these are incredibly high numbers. But Evergrande is just one of developers, and a number of other smaller developers have failed. And the haircuts that the owners of this debt are taking are very considerable. For example, for Evergrande, the settlements are still going on. I think there is going to be a decision in September by a court in Hong Kong, if I'm correct, but don't quote me on that. And so we're probably going to see people getting anywhere between 20 and 25 cents on the dollar, okay? This is a considerable haircut. And if you look at what's happening in China, so largest 30 cities, property sales went down by 21% in July on the year-over-year basis. Country Garden Holdings, which is the largest surviving property developer, basically has defaulted for the first time in the first week of August 2023. That missed bond payment is a considerable deal. Of course, I mean, technically, it's not quite a default yet because they have about 30 days to cure that, and there is some hope that they'll actually make it. But this is a company where its sales went down by about 60% year over year as of July. They're probably going to lose close to $8 billion for the first half of 2023. Overall debt is a little less than Evergrande was, but still it's about $200 billion. And again, my suspicion is that it could be a lot more than that too, right? Because, sort of there is some murkiness in that accounting, and there are some deals that you don't really see reflected in the financial statements. But this debt is really pretty considerable. And Country Garden was one of the companies that the Chinese authorities basically used as a model of a real estate developer. So best of the best. And if best of the best is doing this poorly, that's going to be a pretty big issue. And so you can kind of see that, the debt that matures in January of next year is currently trading under 10 cents on the dollar. So which means markets expect to be, this to be a default. And this is a pretty considerable challenge, right? Because think about that connection between wealth and consumption. If you are a Chinese family, a Chinese household, and just like for everybody else, about 70%, and for many families, close to 100% of your wealth is in real estate. that basically, and the value of that real estate is falling. That's going to impact your consumption for a very long time. And that could initiate an economic problem that could last for years and years and years, right? Sort of, it basically took Spain, what was it, about 8-9 years to come back from their financial crisis. And in Spain, real estate accounted, I think, for a smaller percentage of the economy compared to China. And so this could be really bad. And what's not helping this is that it seems that the country's government is not really taking a very strong set of fiscal and monetary policy actions, because central bank interest rate is still around 2%. I think the Bank of China had lowered by 0.1%. But if you have that, roughly 2% interest rate, and inflation is negative, right? Sort of, you're experiencing deflation. That's not helping you one bit, right? There is also no significant fiscal stimulus action. So central government is not spending. Central government is telling the local government to spend more and to borrow more money. But think about those municipal governments. They derive a lot of their income from selling land to property developers, and this source of income has basically dried up. There is really, as far as I know, there is still no real estate tax to speak of. There is, sort of, income taxes in the United States really account for a significant chunk of those revenues, and that's certainly not the case in China's municipal government. And so overall, this government action plan seems to be really very cautious, and like it's not going far enough, and this is not helping. So, and sort of, China's government came out of a number of plans, right? And sort of, some of them, you look at those plans and they're saying, oh wow, they're extending amusement park hours. So this is taunted as one of the responses, right? They're making it easier for consumers to trade in old appliances. This seems like a very, very surgical, very limited approach. There is other good things taking place, right? Because there seems to be improvements in intellectual property protections, but even that on its own can actually hurt economic growth in the short term, right? Sort of, if you have a number of producers who basically don't really care about IP protections very much, right? And all of a sudden they're forced to comply, that basically can shrink their production levels. It's probably going to be really good for the, in terms of the long-term developments, but still, China's government is trying to remove some barriers to entry in select industries. There is some improvements to the internal labor mobility because, sort of, for labor, for folks who are born and who reside in rural regions versus cities, unfortunately, their ability to get jobs is very, very unequal based on those limitations. And hopefully, if China can improve that internal labor mobility, that will help in the long run. But so far, these are really very surgical improvements, right? And so the expectations for the future, sort of, if you ask me, so it looks like there is going to be considerable trouble ahead, right? Because, on top of everything else, the population is aging very, very quickly. And just for giggles, let me try to see if I can actually click on that. So let me undo the pointer. Let me turn that off. So if I try to open that page, let me try to move it to the screen. I think this visualization is really quite good, right? Sort of, right now in 2023, China is basically at the sort of, this is what the distribution looks like, right? So you have still relatively few folks who are in the official retirement age, right? And so there is still, but you can kind of see that the majority of your people of working age are kind of between 30 to 65, right? Sort of, that's one thing. And if you had to compare that to what it was, let's say back in 1972, then this looked quite a bit more like a pyramid, right? But this one family, one child policy is really impacting China quite a bit. And if you're trying to estimate even what will happen, let's say in around 2050, right? So in 2050, this pyramid is inverting quite a bit, right? Sort of you are seeing, sort of the foundations being very limited, right? There is a lot of people here in this old age category, right? Sort of folks live longer and longer and longer because of medicine. This is going to be quite considerable. And if the current trends continue, and of course, this is a very big if, but sort of look at the projections for say 2070, right? It's getting worse. It's going to be really hard to sustain for the working age population to sustain an incredibly high number of retirees. And the big challenge here too is that China simply didn't have a very strong social security net system. Sort of there has been work on that over the last 15 years, but still, generally speaking, if you are retiring, when you're retiring, you will primarily rely on your own wealth, and a very big chunk of it is in real estate, and you will rely on your family as well. But as the population shrinks, and it's going to become extremely, extremely difficult. So unfortunately, this is not looking great. And sort of my expectation is that China is going to be in for a few difficult years, right? So and we'll see, and and China's economy obviously is going to impact the rest of the world quite a bit. But anyway, folks, I'm happy to take any of the questions that you have. If you want to unmute yourself and speak up, please go ahead.
Yeah, I put it in the chat. Basically, I'm curious about the implication on RMB versus USD.
That's a good question. So, well, the Bank of China does exercise a considerable amount of control on the exchange rate, right? And so, from that perspective, it's probably going to be a little bit easier for the Bank of China to essentially, devalue the country's currency, because it can print more currency and sell it on the open market, and basically make the dollar appreciate more vis-a-vis RMB, right? Sort of that's a possibility still there. But generally speaking, if you have a considerable drop in imports, or a considerable drop in exports, and a considerable drop in imports, I mean, the exact exchange rate probably is going to depend on what has shrunk more, right? And so we'll still have to see how that works out. So, it's not, a free market in terms of that exchange rate, but it's a combination of the free market and significant intervention possibility from the central bank. So my expectation is that China's central bank will do its best to keep that exchange rate low, and so there is not going to be very, very significant swings. But they'll have to see how that cookie is going to crumble. All right. Anything else? Any other questions?
Now, Professor, how about what do you think about China's investment in infrastructure projects all over the world, right? I mean, China is investing a lot in Africa, in Asia. Do you think it will slow down?
My expectation is that it probably will slow down. I think it has slowed down already, right? So China is learning, I think, a number of valuable lessons. I mean, first of all, the considerable investments that it's been making in Africa. There's a number of African countries that are defaulting or are at the brink of default, and China had been extremely cautious in taking haircuts, as opposed to, say, Western debt holders. But it's kind of being forced to take those haircuts as well. One thing that has helped China as opposed to other countries is that it tends to engage in very targeted investment and to take ownership. For example, if it invests in the infrastructure, it will take ownership of infrastructure, or in the case of default, it can, take even a more considerable share of that infrastructure. But it depends to be seen if the other countries would actually be able to give that up very quickly, right? Because those sovereign governments, they can take their own action. And, sort of it has been done before. Other governments have nationalized industries, they have expropriated industries. And when push comes to shove, nobody wants to upset China very much, right? But at some point, other countries, governing regimes may make a calculated decisions that they're okay in terms of upsetting China and taking back the ownership of those infrastructure projects.
Thank you, Professor. And one more thing. Recently, actually, a few months ago, there was a lot of activity going on. Actually, in the news, at least, China and Taiwan. So, do you think that will continue, or China is going to slow down on their aggressive? Pardon my language. I'm not trying to offend anyone. But what we heard in the news recently, that China was being more aggressive towards Taiwan. There were so many military exercises, and U.S. official visiting Taiwan, etc., etc. So, do you think that part is going to slow down as well, or China is going to be more aggressive to divert its population's attention from the economic issues towards Taiwanese problems?
This is a great question, and it's a very difficult question to answer. I mean, unfortunately, the answer is it depends, right? Sort of on the one hand, China can ill afford, sort of a significant military conflict, right? Because there is too many variables in conflict, right? And sort of there is too many variables in play, and that war is going to be extremely costly. And sort of for folks who say, oh, but economies grow during the war, think about that as the equivalent of saying, okay, sort of like one way to stimulate the economy is just like for me to take a rock and throw it at my neighbor's window, right? Because if a window gets broken, then sort of somebody will be forced to replace the window. That will create the jobs for the people who engage in this work, right? And sort of you can kind of see that this seems to be a relatively ridiculous idea, right? Generally speaking, wars destroy resources. They sort of can create incredible pressures on the governments, right? They impact the trust in governments for a long time. So war is not going to be good for anyone, I would think, right? On the other hand, China is still very much an autocratic regime, right? And unfortunately, one of the trends that we've seen over the years during this century, when autocratic regimes get in trouble in terms of economic growth, one of the ways to shut up the malcontents in the economy is to engage in this exercise of building up patriotism and starting war somewhere, right? Because this way you can blame your problems on somebody else. You can shut down internal dissent considerably under the wartime provisions. And sort of, my hope is that China is not going to go in that direction. But, unfortunately, the experience in multiple countries shows that autocratic regimes often take an approach like that, right? But I'm not a political scientist, I'm an economist, so I can't really comment very much on that. But, I'm happy to, hear what other folks think. What's your own expectation?
Oh, sorry. I'm not I'm from Taiwan, but I'm not gonna comment on this. It's a very complicated situation. I do have a question regarding the correction that the real estate sector in China, because my understanding is that a lot of this wound is self-inflicted because the Chinese government tried to rein in the runaway debt situation used in the real estate sector. So it implemented this 3 red line policy, which a lot of us have known about it. And ever since then, the real estate sector started to show a lot of this kind of defaults and all that, right? So that's my question. So I feel like there's a lot of things actually done by Chinese government and its poor policy. And that leads to my question is, I don't know if it's a poor policy or not, because there is a need for deflating the real estate sector for sure. The reason that the Chinese government is not gonna give a lot of easy credit at this moment is because it has already a lot of debt. So it seems prudent to try to rein in all this runaway private credit and government credit, or whatever you're gonna call that. And so just for the, the financial stability of having such much more prudent credit policy. So do you think that Chinese government is really gonna go into the route of just like open a gate and just give credit to everybody who walks in?
This is a good question, right? So on the one line, so you're referring to those 3 red lines that the Chinese government established in the, in the last couple of years, which was kind of pushed by the Evergrande. So, and these were essentially rules such as ensuring, sort of liquidity, right? Sort of you establish a certain liquidity ratio that real estate developers have to meet. On its own, it's really not a bad policy, right? But sort of has it contributed to the slowdown in the real estate market? It absolutely has, right? But I think the mistakes were really made in the past, right? Sort of, it's not so much that those 3 red lines that the government had established that were an error, but those errors, they lie back, decades ago, right? I mean, it starts with the whole one family, one child policy, right? Sort of that's one major mistake that has contributed to that. Because, sort of that is going to impact demography considerably. And even when the government essentially got rid of this policy and started promoting the idea of families having 2 children or 3 children, at this point, China's population demographics are very different from what they used to be before, right? The opportunity cost of having a child is very high to a given family. So families are still choosing to have 1 child because to have 2 children is extremely expensive in terms of what you're giving up in terms of your career growth, in terms of what you're giving up of your income, right? People simply can't afford to do that. And raising children is still fairly expensive in China, given some of the limitations of the school system, which still exist, right? China made a significant mistake in terms of not addressing the social security policies, because it started seriously addressing them only about 15 years ago. And to this day, they're still extremely unequal, right? So, folks, there is still a significant number of folks from rural China who simply have no social security net whatsoever. For folks who have been contributing to the social security system since the reform, sort of, they still haven't contributed very much, and they cannot expect to have a sizable, sort of retirement pension. And to a large extent, because the system is so very new, people simply don't trust the system enough, right? Sort of because, they've been burned many times before. They've been burned many times with the, bank closures and bank failures. So if folks want to have a stable way of saving for the future, real estate is that way. But now when even this option seemingly seems to be taken off the table, it's going to be really, really tough. So I think the roots of those mistakes are, decades in the past, right? And the China standards on those 3 red lines, they actually are, decent standards. They're a reasonable attempt to contribute to that. But, sort of my fear is that some degree of bailouts is going to be necessary, right? And so some spending needs to take place. Even if what that spending does is that it increases inflation. Inflation right now is very, very low. And so you can still, you could be better off by having higher inflation and, sort of less default. But again, is this going to be a long-term fix? It's hard to say. It's really hard to predict.
Interesting. Thank you.
Yeah. All right. folks, any other questions or comments? And happy to have an open discussion too. Sort of I purposely kind of kept this, sort of relatively limited amount of material. I'd love to take your questions about anything else and, try to do my best to answer them. Or have you share what you know?
Hey, Professor, I know you mentioned some of the African countries are close to defaulting. Is there a resource or somewhere where we can look up which countries those are? I'm curious because we do a lot of business in Africa. So
I won't be able to answer that, off the top of my head, but I can certainly look for it, right? And sort of if what you do is that, and I think sort of some of the simpler measures might be to take a look at, for example, indebtedness as percentage of GDP. That could be a good indicator of countries who are really struggling, right? And sort of even if you compare that to, for example, sort of economic growth rates, that could give you a very, very good sense of who is kind of losing that fiscal space. And there is a number of countries who are losing that fiscal space very rapidly.
Great, thank you.
One of the problems here is, unfortunately, a lot of the arrangements in borrowing by African countries very often simply will not be reflected on the government balance sheets, right? Because there has been a lot of opacity and not a lot of clarity on those deals, right? And part of it is explained by corruption, unfortunately, right? Governments enter all of those private deals. Sort of they try to create all kinds of mechanisms to conceal the scale of the borrowing from everybody else. And so, unfortunately, the result of that, time after time after time, when they start taking a much deeper look at the country, and when the country starts defaulting, all kinds of loan holders start coming from across the world, and the scale turns out to be much bigger than everybody expected.
Professor,
Right.
so the trouble with Chinese economy right now, do you think it's going to affect US economy as well? The reason I ask is that China holds almost like close to $1 trillion worth of US Treasury bills. And do you think they will be offloading some of those and it's going to have some kind of ripple effect somewhere in the US economy?
Excuse me. Well, I think, sort of there might be some possibility of offloading this money, right? Even though, generally speaking, if what you were trying to do, you were trying to essentially get the dollars, sort of, and then repatriate those dollars back into the economy, that might still be problematic because that might contribute to the appreciation of Chinese currency. And so that's what you want to avoid doing. So China likely cannot take any major steps in terms of floating its debt. If it does offload its debt, it will likely, create plans to do that over the period of 10, 15, 20 years or something like that, so that the individual impact year over year is not all that pronounced.
Thank you, Professor.
Okay. All right, folks, anything else? Any other questions? All right. So just to ask you, sort of, I know I've seen that there is interest in doing a session on India and India's economic growth. So I'm taking note of that, and I'll talk to Hadi about that, certainly. Any other ideas for future discussions?
Professor, there is a lot of talk about, work from home, right? And how that's going to affect the economy. That's one topic I would suggest. And there's one more thing I forgot.
Okay, well, feel free to shoot an email if there's any ideas. And what I'll try to do, I'll try to run a poll in our group on LinkedIn and see what people think. And so Hadi and I will plan to do something, sort of fairly applied in September and October. Okay. All right. Well,
Professor, just one other thing. So I think there was there's chip manufacturing initiatives in the US ongoing. There was an article in Economist about that. So it will be interesting to see like where is the focus in terms of technology in the US and
Yeah,
overall
that's a great topic, right? And sort of, you know, cheap manufacturing and all of this building of the capacity seems to be running into major issues, and a lot of those issues are related to labor, right? Because there is simply not enough people with those fairly specialized skills, you know, to make this happen. So yeah, that's going to be interesting. So I'll make note of that. So we could certainly talk about that.
Thank you so much for hosting these again. Very
Okay.
insightful.
All right. Great. Thank you very much for joining. This is I really enjoy seeing all of the folks who, you know, many of you have graduated already, and you know, it's a great opportunity to reconnect and to talk more about macroeconomics.
Me counted. Thank you so much, Vlad.
Thanks so much. All right, folks. Thank you for joining me. So please continue interacting with the group on LinkedIn. If there is topics you'd like to see covered, then let Hadi and myself know. We'll be happy to do something related to those topics. I'll post a recording of this on YouTube and post a link. And talk to you soon. Thanks all. Bye-bye.
Thank you, Professor.
Thank you.
Bye.